Hello and welcome to the 5th edition of our Investment Insight series, Magellan Minutes. My name is Jennifer Herbert, Head of Listed Funds at Magellan, and today I'm joined by Hannah Dickinson, Head of Franchises. Today we'll be discussing how the consumer sector has stacked up over the past 6 months and why it's been such a challenging operating environment for retailers. Thanks for joining us today, Hannah.
Thanks, Jen.
Hannah, it's been a very difficult year for markets. How has the consumer sector fared?
Yes, it has. We've had so many different shocks. It's kind of hard to believe, but we've had, over the past 2 years, a global pandemic. We've had a Russia-Ukraine war. We've had rampant inflation, rapid quantitative tightening. So all of these things combined are huge shocks to markets. So it's no surprise that we've seen such a volatile year. I would say overall the consumer sector has held up relatively well, but when you dig into the detail, there's a lot of variation by subsector and also by company. So during times like this, when recession fears are front of mind for investors, we tend to see consumer staples companies outperform, so companies that have resilient business models and cash flows. Also, quick service restaurants tends to be a sector that does well because consumers might trade down into those types of restaurants rather than going out. So that has certainly, that part of the portfolio and the market has held up well. And then you tend to see discretionary subsectors like retailers, fashion apparel brands, they tend to do worse. But then when, again, digging into the detail, you often see quality companies outperform in these sorts of markets. So there's a flight to quality. Investors are looking for a safe set of hands, and that has all kind of performed in line with our expectations.
A recession is certainly the number one fear for most investors, but what do you see in terms of consumer demand and company performance? Can you lift the lid on some of the trends that you're seeing there?
Yeah, so I said before that performance has varied by subsector and by company, and consumer trends are similar. They're varied as well. So we're seeing variation in terms of consumer cohorts. So you have younger, often lower income consumers who are being particularly hit hard by some of the inflation we're seeing. Their household budgets are being squeezed. And so we're starting to see those consumers at the edges trading down within particular categories or trading down to different types of retail models like discount retailers. Then at the other end of the income spectrum, we're seeing higher end or higher income cohorts remaining very resilient. Their household budgets haven't been as impacted as lower income cohorts. They tend to be more reactive to share markets and property prices. So they tend to be more of a lagging indicator rather than a leading indicator. So overall, I would say, again, mixed outcomes. I think US retail is going to be a really interesting space to watch over the next few months as we head into the holiday season. They've had a really challenging operating environment to contend with since COVID, struggling to predict where consumer demand patterns will fall out, and also struggling with severe supply chain backlogs. So there's a lot of excess inventory in the system that they're going to need to clear. So we're expecting to see quite a highly promotional environment over the next few months, and that often results in earnings downgrades. So while everything we're seeing out there is a bit uncertain and certainly very mixed in terms of trends, I think these are the sorts of times when you start to see really exciting buying opportunities. So we tend to look at market volatility as something to get excited about rather than fear.
And so how is our consumer portfolio positioned with regards to these risks?
So I would say as a whole, we are quite defensively positioned. We tend to hold quite a lot of consumer staples in our portfolio and really high quality consumer staples like PepsiCo. Pepsi just reported 16 or 17% organic earnings growth in its third quarter, which is exceptional for a sleepy staples company. A lot of that was driven by price mix and volumes were flat to slightly down. So that's a sign of a really, really strong company with strong brands and strong pricing power. So companies like that in our portfolio we feel really good about. We also feel really good about the quick service restaurants like McDonald's and Yum that we have in the portfolio, they have resilient business models as well, franchised business models that are very defensive in an inflationary environment like this. Then at the other end of the spectrum, we do have some more discretionary holdings or companies that you might consider to be more cyclical. So they've kind of been a bit impacted by some of the fear that's in markets at the moment. So companies like Louis Vuitton Mo, Hennessy, Diageo, L'Oreal, we've decided to lean in to the fear and be greedy when others are fearful, so to speak. So we have upweighted those companies in our portfolio, and we just feel like they're attractively valued and they're such strong, advantaged companies. Louis Vuitton was another one that just had an excellent result, much to the surprise of some people who were expecting to see a bit of some headwinds come through in luxury demand. They're not seeing that at all. In fact, it's incredibly resilient. One thing that the CFO was asked about was pricing power. And the analyst on the earnings call asked, how does a company like this have such great pricing power at a time like this? And his response was really interesting. He said, companies aren't just born with pricing power. It's not something that's preordained. You don't just have it. You have to build it. And it's a sign of a desirable brand if you have pricing power. And a desirable brand is really the result of years and years of hard work on the part of the brand owner. So we're looking for companies that are stewards of brands that they own. We're looking for brands with heritage. We're looking for brands that consumers will want through cycles like this. And we feel that we have a great portfolio of brands like that today.
Fantastic. Hannah, thank you for your insights today.
Thank you.
And thank you for joining us. If you have any questions, please don't hesitate to reach out to the Magellan distribution team, and feel free to share this update with clients and colleagues as you see fit. Take care and see you soon.